In this presentation, we will enter a reversing entry related to unearned revenue within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here is our Get Great Guitars file. We're going to see what our objective is by going to the reports on the left side and opening up once our favorite report, which is the balance sheet report. We're going to change the dates up top from 01/01/19 to 02/28/19 and run that report. We're going to see the adjusting entry we created, and then we'll think about why we want to reverse it and how we will reverse it. We made an adjusting entry related to the accounts receivable. So the accounts receivable is here. If we select the accounts receivable, we scroll down and we can see that we have our adjusting entry for it that is going to be for the 300, which is here. So we had an adjusting entry for 300, increase in the accounts receivable for this negative amount up top. And if we want to see more detail on that, which we do, I'm going to scroll back up top and we're going to go back to our report summary, and we're going to right click on this tab, duplicate it to have two tabs, pull the tab from the left to the right. So now we have the balance sheet and the second tab. We're going to then go down to the reports. We're going to open up in the reports Who Owes You report, which is going to be the customer balance detail report. And we'll select that item, customer balance detail, and scroll down, and we'll see the detail of that, and that's going to be this negative 300. So before our journal entry, we had this negative 300 for string music, which is unusual. It would represent string music owing us money. We then adjusted that by removing it. Now again, why would we have that? Why would that be the case? Because we put the deposit as a negative receivable. That logistically is easier because it allows us to then apply the future payment, the invoice or the sales receipt, to that deposit within the account that it's assigned to do so within the QuickBooks system, accounts receivable. So this deviates from the normal adjusting entry and therefore reversing entry. So let's go back to the balance sheet and just note that the reversing entry that you might see in financial accounting from a normal textbook problem would be related to something like selling newspapers or something like that, rather than the problem we have here, which is kind of like a deposit on inventory. So if that were the case, say we were selling newspapers, we would typically have an unearned revenue account on that would be increasing as we make sales, but we don't yet do the work for, say, selling newspaper subscriptions that we're going to do in the future. We would be increasing an unearned revenue type of account. And then we would determine how much of those subscriptions we have done on a periodic basis, month to month, reduce the unearned revenue, and then record the other side as revenue as we've earned it. We here are doing a bit different problem. It's a bit different situation that's a problem. What we're concerned with isn't with the amount or being able to determine when we've earned the revenue. We'll still be able to apply that when we make the invoice or sales receipt. What we want to be able to do, however, is make sure that we can apply that to the subsidiary account, the account by customer. And so that's why we have our problems a bit different, where we're going to say that we're entering the deposit as a negative receivable, and then when we have the invoice, when we complete the job, do the work, we apply it out to the accounts receivable. Everything's okay at that point in time. However, if we have that outstanding receivable as of the end of the time period, then we have a negative receivable and we should have a positive liability. So the problem's a bit different than you might see in normal financial accounting, but logistically you'll see this in practice, and this is a common way that it can be dealt with. So what we've done is we've made an adjusting entry. Because there was that negative receivable, we said, all right, we'll just fix that as of the cutoff date, as of February 28th. We'll just increase the accounts receivable by any amount that's a negative within the customer balance detail. If we go back to the detail, which was this 300, we're going to say, okay, we're just going to increase that by 300 periodically, just so when we present the financial statements, the overall overarching accounts receivable is correct, and record it where it should be, not a negative receivable, but a positive liability. So now we have a positive liability instead of a decrease to the accounts receivable. So now what we want to do is in the following period, we don't want to mess up the accounting department. So we're thinking of them two different departments. We don't want to mess up our normal process. So we did this in order to look correct as of the end of the date, the financial statement date, the cutoff date, February 28th in our case. Now we want to reverse it so that we can go back to the other system, which works fine, it works great for just normal logistic purposes. Once we receive the payment, we want to be able to just apply it to this negative payment. Once we receive the invoice, we want to apply it to this payment, even though they happen in reversed order. And once that's done, it'll all be fine, and we'll be able to track everything by customer, and that's what we want to do. We want to keep everything, in other words, in the accounts receivable account related to customers so that the software will be able to tie those things out no matter which order they happen in. So to do that, we're just going to make a reversing entry. Now, so here's the adjusting entry we had. If we select unearned revenue, here's our journal entry. If we select that item, we had made the journal entry to increase with a debit accounts receivable by 300 and then increase liabilities unearned revenue by 300. All we're going to do now is reverse that as of the first day of the next year. Why the first day of the next year? Because we want to make all of our reversing entries as of the first day of the next year. So that's just the convention. Even though, again, it's not perfect accrual, it's going to be something that's logistically easy for us to do, and therefore it's worth it to do it, even though it's going to make it so we're not completely correct in terms of a few days. In other words, if we go back to this report, we're going to make it so the negative amount returns, so we have the negative payment. Once we receive the invoice, everything will be okay, but we might not receive the invoice till like, let's say we receive the invoice on March 10th. And if we do this reversing entry, this negative receivable is going to be wrong for 10 days in March. But that's okay because we're willing to accept that wrongness of 10 days, just like we are when we do the adjusting entries where we have perfectly correct accounts till the end of the time period. We're willing to accept that to make things logistically easy in that we have all of our reversing entries in one day and we can find them easily, and we could separate the adjusting department from the normal data entry department. So that's what we'll do. We'll make that a reversing entry. We're going to right click up top, make another form to do this on. We'll duplicate once again, and we're going to make our entry up top. So we're going to say this plus item. We're going to enter a journal entry in other, make it a journal entry. We can't really use registers even though there's only 2 accounts because we need that customer field. So the accounts receivable kind of messes things up to use the register. Now, all we're going to do is reverse what happened. So the unearned revenue now is going to be a debit because we credited it. We increased it with a credit. And if you don't understand debits and credit, that's okay. We could test it. You can go one way and then reverse it. So we're going to say this date, this is important. The date should be the first day of the following time period, which in our case is March 1st. And then it's going to be unearned revenue. That's a liability account. We'll take that. That's going to be debited 300. We're going to call it a reversing entry. I'm going to copy that so that we can put it down below as well. The other side is going to be accounts receivable. Accounts receivable. It too, a reversing entry. And we need a customer for the receivable. And remember the customer, if we go back, was String Music. They're the troublemaker. So String Music, we're going to say String Music wanted that custom guitar and made us do this whole thing. So we'll save that and we're going to say save and close. Now we'll go back to reports on the left and let's open up our balance sheet. Go into the balance sheet and we'll change the dates back up top once again. 01/01/19 to 02/28/19 and run that report, and it'll still be there of course as of the accounts receivable here. So the accounts receivable were still good. If we scroll down, we could still see that adjustment that we had. A lot of activity here, so here's the adjusting entry. If we then go back up and we go back and change the date now to the end of the next period, so this is including the period that hasn't gone yet, hasn't started, we haven't done it, March 03/31/19. We're going to run that report. And now let's go back into the accounts receivable. And if we scroll back down, we will see that we have the adjusting entry and we have the reversing entry. So here is the reversing entry now. So this is going to be the reversing journal entry. Here's the journal entry for us to adjust it. Here is the reversing entry, and we have the original 300, which is way up here, the string music deposit, which wasn't matched out to any payment. Here is the adjusting entry and the reversing entry down below. So here's the adjusting entry, here's the reversing entry. It's more clearly seen if we go to this by the accounts receivable by customer, and we in the second tab, run that report once again. And if we scroll back down, it's more easily seen because now we can see it by this particular customer. So the customer made a prepayment. Here's the prepayment. We reversed it out in the adjusting entry to bring it back down to 0 as of the end of the time period, putting it into not a negative receivable, but a positive liability. And then we reversed it. We changed it. We put it back to that 300 negative, so that we can now, once the accounting department gets a payment, they can just process once the accounting department issues the invoice or sales receipt to actually give the guitar, they can just apply it out as they normally would. They don't have to worry about unearned revenue, some account that we don't typically deal with. It could just be tied out here and use the customer accounts. So let's go back. We're going to go back to this item to go back to the balance sheet, and we'll go back to the reports summary. And we'll scroll back down to the unearned revenue. It's now at 0, so that's as of the end of the second month. And if we scroll down, this is what happened. We increased it, the liability, what we owe, either the money back or the guitar, hopefully the guitar that we owe. And then we reversed it as of the first day of the next time period. So this is actually proper. This is what it should be. But logistically, it's not as easy just to basically work with. We reversed it as of the first day of the following period, which isn't exactly right. It won't reverse entirely until we actually give the guitar and enter the sales receipt or invoice. But we make our reversing entries as of the first day of the next time period because that's going to be easier for us to find them. If we want to know what reversing entries we've entered, we don't want to hunt around for them. We want them all to be here. This reversing entry is just a timing difference, so it'll work itself out over time. When we create the invoice or the sales receipt to tie out to the payment, then this will no longer be an issue. So we're going to be correct periodically as of the end of the month when we did the adjusting entry, and then we'll reverse it to make things logistically easier on the accounting department, and it'll be then correct once that point in time happens that the actual invoice is done. We deliver the guitar, invoice made, sales receipt is made. For more accounting information and accounting courses, visit our website at accountinginstruction.info.